Pete. This is the age-old. I don't know if it's a joke or a cliche online. Is buying the dip, and if you do it, it almost always works out unless you get caught in one of the crashes that occur around once or twice every decade. And you could see that this is what stinks about creating content sometimes. Is I wrote this article on Wednesday and Thursday of last week, which is the newest edition of the newsletter that goes out to our community members on the best
dips. Just printed mine out.
Thank you. Appreciate it. The best dips to buy. Pete wrote this Wednesday, Thursday last week when it was markets were tanking. Crude oil was getting down to $62 a barrel, and stocks were down 1%, 2%, 3% per day the first half of that week. Open up your newsletter here on Monday after it's been written and edited and everything else, and the market's already bouncing back. But I don't think we're necessarily out of the woods. What do you think?
I don't know. It's I'm bearish, but the rallies are unrelenting. There's a lot of force behind this rally, so I'm a little surprised by it. So again, you know what? As weak as they looked, when we talked about trying to put together the beat up close that was, I think, last Wednesday when they really pounded the market the hour after the cash market closed and opened lower, but that was a heck of a level to buy them at. So selling the halfway back bounce that I like to do is not a profitable strategy.
Patience needed on selling the bounce, but buying the dip, also some patience needed. But we put together some great statistics for our community members. Again, if you want this exclusive content and lower cost to trade, you actually get 50% off your exchange fees on every trade when you trade the smalls for life, as well as shirts and hats that we've been sending to our community members. Go to community.thesmallexchange.com. If you join this week, hit me up on Twitter or email, and we'll also fire off a hat your way for joining here this week, community.thesmallexchange.com. But in this exclusive content, Pete, I put together some of these statistics, and I want to know if you're surprised by any of this stuff, because here you have the likelihood of a positive close the day after a big dip, and then also you have the average moves and standard deviations. Now you have a large percentage likelihood of stocks and metals bouncing, not so much for interest rates and crude oil, but interest rates actually had the largest rebounds after big sell-offs, everything except for crude oil in positive territory after these big sell-offs, which is why buying the dip is such a ubiquitous phrase. But are you surprised by any of these numbers up here? 65% for stocks, only 54 for rates, but you've got 10-cent average move in stocks and 25 in rates. It's kind of an interesting dynamic.
Yeah, very much so. Am I surprised? Yeah, I am. Especially, I'm not surprised at I'm surprised at the 50-50 in crude and the metals. And why I say that is that they tend to be a little bit more unbounded, and we can see what we saw in crude is, as strong a day as we're having in crude. And I haven't had a chance to look, but I know we're a lot higher than 61 something as we saw last week. That move from 74 to 61 was unbounded by, I think, 8 straight down days. Yeah. So, that's why I would think the 53% wouldn't hold, but I am a little surprised by that.
You're right. It is actually a decent amount of edge for something that does tend to trend. I'm even more surprised by the fact that metals have been bouncing back, but I guess that is an ode to the fact that metals have been acting like stocks a lot in recent years here. And you're seeing it today. Where metals are bouncing, gold and silver bouncing back pretty significantly here with the stock market. But I think this is all to say, Pete, and I asked you about whether you think that we're out of the woods or anything like that. I don't necessarily see, a 20% or 25 or 30% dip in the equity market by the year's end. Well, we got one last year.
I couldn't agree with you more, as unfortunate as my position seems. I can't disagree with that.
What we can take solace in, though, Pete, is I think that last week and the start of this week, is more participants getting back into the market. Like this looks
yeah.
does
But you know what? It's funny because I've heard that, and I definitely agree with you. You can look at volume at anything. Actually, except small exchange products, which is held up pretty good.
yeah.
Um, but
Well,
and we'll see that
everything
volume come back after Labor Day. But I sometimes everybody's like, oh well, this rally is fadeable because the market's thin. What I found more often than not is be careful about that, because the market comes back and doesn't it doesn't revert. In other words, we don't see a big sell-off first week after Labor Day in that, or a big bounce in some of these other things. So I'm a little bit more guarded that the market is randomly directional because the composition of liquidity is less. So I'm a little bit more mindful of that.
I think we're going to see more randomness, and you're totally right. When we were in the I guess we're actually now in what's technically the dog days of summer, but when we were in June and July, everything fell off in volume, like significantly. All the different futures from different exchanges to your piece, except for small exchange held in pretty decent. But I mean, some of these markets got cut in half in terms of their daily volume. Last week and this week feels like people are back online. There's more people in the market. There's more people on social media and otherwise talking about markets. And we're seeing just like what I view as real flows in and out of equities, in and out of interest rate markets and metals and everything else. And we've seen this with trends in the past, right, Pete, where it's like every year it seems like people get to stuff earlier. Ag markets, everybody was trading those on a very volatile basis in essentially winter and spring, when usually that volatility is spring and summer. And a lot of people historically will tell you, oh, October is the most volatile month for equities traditionally. And it's, for whatever reasons you want to assign to it, and probably most likely the biggest reason is that the '08 crash there happened in October. But like, there is something to the fact that these trends exist and people tend to jump on those trends earlier and earlier. And I think we're starting to see a little bit of that volume come back and this back and forth action come back a little bit earlier here in the end of August. And I think September will be a really big month for back and forth action. And so you got to keep these statistics in your back pocket, because these all-time highs that we're seeing in equities, like I say, I don't think we're going to see a 20 or 30% reversal by the end of the year here, but I think we're definitely going to see some 3% down days in equities. And then, like we're seeing today, a 2% bounce in equities. And so you have to have these stats, because what dips should you buy? You can see here that commodity dips are not necessarily as strong, but stock and interest rate dips there, you got to keep your eyes out for those.
Yeah, absolutely. I mean, it's a good stat because it goes back to our trading direction and how do we turn that 50-50 bet into something more.
Absolutely. And so with that being said, what can you do with commodities? I think you can really trade both sides of these markets. If you were able to catch that bounce, if you had that patience to not, that's a market where if you see 1 or 2 days of a dip, you should probably wait for 3 or 4 or 5. It's almost like, and Pete, maybe you can comment on this. I would almost double what my standards are for trading the stock market when I'm trading commodities. Like, does that sound right from an intraday perspective
absolutely.
And a multi-day perspective, right?
Yeah, I think, well, the numbers kind of bear that out too, but yeah, absolutely. You know what? There's, I don't know if the right word is elasticity, but there's more elasticity in the propensity for these to be unbounded. What I mean by unbounded is there's not as many tradable like instruments like WTI crude, where you've got, S&Ps, SPX, SPY, the baskets themselves, the underlyings, all these places for liquidity providers. And remember, that's what keeps the market stable. to run and hide. And what I mean by that is to lay off risk from one place to another. So this becomes, it's the nature of commodities being more primary markets. And not to go too deep, but like for oil, for example, all the physical oil trade, all the cash market, so to speak, of oil is priced off of where the futures trade. Mm-hmm. So when you think about that, that means it's the primary determinant of prices for the entire downstream cycle of, refiners selling to other producers and drillers selling to refiners and everything. So that means that market has a lot more proclivity to struggle to find bounce. So you're absolutely right. This is kind of a long, overly complicated answer to I agree with you. You need to add more elasticity to your bounding to be successful.
No, but that makes total sense, and I'm glad to hear you explain it as such, because the numbers do bear it out. That is the exact yin to my yang, which is like, here are the numbers, and you're seeing that the stock products SM75 and sticks are on an average day moving 50 cents to $1, and your oil product is moving twice that almost. And you're seeing it today. If you sold SM75 up $1, you'd be out, $50 or so. It's a big rally here today. If you sold SMO, the crude oil product, up $1, you'd be out $300. Like that, right. That's a big, big move, and you have to just have more patience. Now, that being said, I think all of these markets are ripe with opportunity to both directions. And
Absolutely.
we've seen it recently, right, Pete, where we saw, 2 or 3 down days in crude oil, and then a $3 bounce back, and then they sell into it. I think there's opportunity on the short side of this crude move and some of these stock bounces. You just have to make sure you use these small products. You have to make sure you're waiting for, $1.50 or $2 in crude, right, as opposed to $1 or $1.25 in stocks. Do you think there is you can say from your position standpoint if there's opportunity on not only buying the dips but selling these bounces?
Absolutely. Even the metals trade, silver below $23. We got a strong bid into the precious metals kind of out of nowhere. So I think that somewhere along that, you could argue the break of silver, but it's somewhere along that bounce of silver back if we get back up to, upper 24s, or, it's really the equivalent of that 60 or 70 cent move on a percentage basis to spree. Sure. There's absolutely two-sided action, but I think, as you said, the important piece is to have some metrics about when to statistically start to play a directional assumption, and that will then help you set up the mechanics around management. Remember, if you have strategy and mechanics, the management is the easy part. Now, we both know emotionally it's the hard part because we tend to move the goalposts. We don't move the goalposts because we've determined it pre-trade with our mechanics. Management is just either taking the winner or taking the loser, moving on to the next non-denominational, non-emotional trade.
And let's move on to the last part of today's show, everybody's favorite segment, the pairs of the week. Pete is going to now rank from his most liked to least liked pair of the 3 that we have here. Now, bear in mind, again, these markets have moved a little bit since I wrote this stuff up in the middle of last week, and it went out to our members earlier this morning. We have in front of you here, Pete, some hedged ways to buy rates, buy in, and then also buy some more rates. First one on the board is one that we've probably not done a lot historically, but has been a good trade in the last few months, which is the 2-year rate to the U.S. dollar. And we're U.S. dollars in 50 cents right now, but still up above 147, a place that it hasn't been all year. So a little bit of a reversal in that U.S. dollar today, but still at those highs on 2021. 2-year rates and rates in general not budging. They're not seeing this upside. And we see this a lot where rates will either sell off earlier or they won't take part in these rallies. And it's not necessarily a tell, but it does tell you something that maybe we're not out of the woods in some of these markets, that rates aren't jumping higher. Either way, I have for you a long 2-year rate, short U.S. dollar trade here. If we've seen, some of this upside in the U.S. currency, should maybe see some upside in this rates. Or if we don't see some upside in these rates, that dollar should maybe depreciate relative to some other places that are looking at hiking in the future if we're not going to do so. Anyways, that's a 5-to-1 long 5 S2Ys, short 1 SFX trade. Next one for you here is one we talked about last week. Now stocks are a little bit higher, but I think this is still an interesting way to hedge some long yen exposure here at the lows. I have a long SM75 long yen trade for you here on a 1 SM75 2 micro yen MJY contracts. They're just a nice way, especially when we see some of these sell-offs in the equity market. Maybe we'll see a reversal today or tomorrow, to hedge some of that buying the dip, essentially, with that yen piece that's highly correlated to VIX and volatility. So that market, interesting spread to look at, with both of them, stocks and yen down significantly last week. Last one on the board here, Pete, S10Y 2 sticks. And I think this is probably the most relevant for today's market, given a big bounce back in tech stocks and otherwise, and no upside being seen in the 10-year yield or yields in general. Traditionally very highly correlated markets, right, that are just diverging here again. And this has been one of our favorite trades for the last year plus, and that's long 3 S10Ys per 1 short sticks market in there. Now, Pete, what are your favorite to least favorite pairs of the week?
Oh, I love the SM75 yen trade, but you're right. I'm not buying SM75 after the bounce. That's the thing. But that's a trade. And again, these are setups that we're not cherry picking. It would have worked wonderfully last week. You would have lost some on your yen, but you would have more than made it on the SM75 piece. I'm not doing that trade up here. I'm not fitting it the other way, but in terms of the way these two work, that's a great buy the dip trade. That's a great piece of protection to go along with it. So for right now, though, you got to go with the girl you brought to the dance, so to speak, which is the tens against sticks. The extreme is there. We've got a chucklehead meeting this week where these guys are supposed to talk about rates. So that's part of the reason why we're seeing bonds at such in 10 to 30, such a compressed range, tiny range today. No movement considering stocks at 1% up. What were we up? Almost 2%, I think, or 1.5%. But I continue to like that trade. I think that you're going to have to be mindful of the reversion. The extreme is there. It's so pronounced, but you're going to have to accept the fact that those tens may not work for you in terms of that sticks rallying, and you're looking for time. That's what the tens are buying you. If they don't give it to you and you hit your pain threshold just on the short sticks, you have to manage. So I see, again, the higher beta point being the sticks, but the tens should give you some relief. And then the twos to the SFX, I know you're looking for 10 different reasons to sell the dollar here, and I love that. And today you're right. But that would be one. The pair is very, very clever, I think. But I'm not quite sure I want to sell dollars here. That's the problem.
Gotcha. Totally
good trades.
And
tens and sticks, SF75 and yen, and then the twos and the dollar.
Perfect. And I love your point on that 10-year to sticks trade, because that is one that will both give you time, but yes, requires time as well. The reversion, of course, could occur any minute. This is a big divergence. The extreme is there, but this is one where I might have it on for a week or 2 weeks. And it's actually kind of the antithesis to one that worked out very well for us last week. But you and I, remember, we jumped on the show and we were like, this is an interesting pair, but it's one that I don't want to go home with even tonight. Right. And that was stocks against crude oil. And that's one that worked out great, but that's one where it's like, it has to pay me in the next couple of minutes to hours, or I'm not holding long crude and short stocks going into the overnight. For the very reason
we talked about, right.
Because it's just a lower correlation there, and it's a more volatile pair. This one, S10Y and sticks, higher correlation, less volatile pair, one that might take some time to pay me. So some great stuff there, Pete, on the pairs and which
well done, my friend. 3 really clever trades.
And what is your favorite dip to buy in football season as we enter football here? Are you like an artichoke dip guy, or are
Oh,
you like
you know,
a blue cheese dip, or like what do you
no,
got?
I'm an onion, onion soup. I make a dip out of cream cheese, sour cream, and onion soup mix. So that's my,
Wow,
yeah, it's good. I mean, my
interesting.
mom made it for years as a kid. I make it now. Actually, Chris makes it now. He's in charge. So
The
makes it better than
people
I do.
I would love to try that. People these days have been getting really into the buffalo chicken dip. Now, I love buffalo sauce and I love blue cheese and I love all of these things that are components of the
Yeah,
buffalo
but what are
chicken.
you putting it on? Like grass clippings? I mean, you don't eat the chicken anymore.
Well, the chicken, yeah, when I did eat chicken, I'm saying, here's the thing though with the buffalo chicken dip. Too many flavors. You've got too many flavors in that thing. It's like if I bought like Skittles and then I also put like Fun Dip on it and I put like some Nerds on
What
top
is
of that.
fun?
Too
I
many
don't even know what
flavors.
fun dip is, but
You know
sure.
what Fun Dip is? It's like that little packet of sugar, and you get like a stick, and you like lick the little
No.
like stick there, and then you dip it in the sugar, and then
Oh no, we used
maybe.
to have what were they called? The little tubes that had the crystallized flavored
Oh,
sugar.
that's essentially those are pixie
It's just
sticks.
pixie sticks, right? Good for
Yeah,
you. God, I
absolutely.
haven't
Those
seen
are
those anywhere forever. Yeah.
yeah, because I think that they decided that that is
That was
something
just
people don't need
crossed the
in their
line in
lives.
terms of candy.
That was
It's
it
just
was like it's like
there's no
it's what I'm
justification for that.
it's what I'm talking about with the buffalo chicken dip, where it's like, buffalo, great flavors, blue cheese, great flavors, chicken, all these things, great. You don't need to jam them together and then put them on like a nacho chip or something like that. It's entirely too much. But either way, if you enjoy buffalo chicken
I
dip
will. Yeah, go ahead.
or pixie sticks, I like that you brought this up because Fun Dip, it's technically a dip. I would say that Pixie Sticks is a dip, and this goes back to my age old. I try to convince everybody that all liquid foods, be it yogurt or chili, they're all soups. I try to put them under one umbrella. I like this with the
Uh,
dips too.
you know what? Your think tank. I mean, the concepts
Mhm.
that it wrestles with are truly amazing. Just stick with the gazpacho, okay? Just
Gas-
stick with the stuff that works,
I'll stick with the
not
gazpacho.
the
You
pixie sticks on top of some blue cheese. That's no good.
all right? Well, you stick with me, Pete, for 30 more minutes. We got Splash in the Futures coming up next. Thanks for watching, everybody.